Hey everybody, I hope everyone's doing well and had a good day. This is the recap of the 5-minute chart of the Emini for Tuesday, January 21st, 2025. I'm going to keep it brief just because I have a cold and a little bit of a headache, and just looking at the screen for a long time is just kind of hurting my head today. But there's a couple of things I wanted to talk about. So not a full review, but a couple of interesting things. First thing is we can think about how we went into today with a gap up. So here's the price action to the left. This would have been last Friday, Monday being a holiday. I'm not sure why it looks this way with one bar here on the early close yesterday, but gap up far above all these prices. It's a bull breakout. You can think about the gap as a breakout, and think about what breakouts do. Breakouts trap traders, always. There's always, whenever the price moves any distance, even just one tick, one trader, think about it. The trade goes one tick in your direction, that trader is happy, and then the trade goes one tick against another trader, that trader is disappointed. There's obviously minor and major disappointment. So if the trade goes against you one tick, not a big deal. But if a trade goes against you 10 points, more disappointing. So think about the gap up. Big gap up, trapping all these traders down here. Second leg, likely. We don't know if we're going to test. We don't know which breakout point, if any, we're going to retest going into the day. Here's Monday's high. This is Friday's high. So we broke out above the high of the prior full day. And look at the follow through. Doji on bar 1, bear bar, strong enough for a second leg. Bar 2, probably going to test the high of Friday at a minimum. 3, getting there, getting closer, probably sellers above 3. It's a weak buy after a stronger bear bar, second leg down likely, probably sellers above. Rally to a new high, but failed breakout. Bulls really want to close at the new high. Might be an expanding triangle, down and up, probably sellers up here, buyers down here. Big bear bar, 5, but expanding triangle, so huge bear bar, but not really breaking out below the bar 3 low, not breaking below the high of Friday. So the bear's not doing enough yet. So after the gap up, we've had a couple of attempts to reverse back down, but we're still completely above the moving average. So traders are buying above the 20 bar moving average. If we think about what the moving average is, it's sort of an objective, agreed upon average price for the close of the past 20 bars. And it's an objective number. You take the closing price of the past 20 bars, you find the average of the prices, and that is what the moving average gives you. But if you think about it, there's a trader who bought the high tick of bar 4 and a trader who sold the high tick of bar 4. So traders agreed upon a price here. And the high of the bar is 6,072, even though the moving average is below 6,050. So traders are buying and selling over 20 points above the, I say agreed upon average price. The moving average is just one measure of average. It's sort of subjective. There's traders that use other methods to decide what's average or fair. There's the 9 bar EMA, the 100 bar EMA, or you might just use the price action. The bodies of the bars are from here to here. So maybe a trader says between these red lines is the average price. So if we break out above or below this range, I'm going to fade the breakout. I'm going to bet on it failing. Because it's fractal, and I'm not sure if this is even accurate, but the way I think of it is that every trader, every tick Let me back up. If there's an institutional trader, an institutional bull and bear on every tick, then every tick must be a fair price because the price went there. A trade was executed at that price. We had a buyer and a seller. Both are assumed to be institutions, since the institutions make up maybe 90% of the volume traded, maybe even more. So every price, what's the job of a market? To facilitate trading. And it's doing its job on every tick. It's at a price where there's a buyer and a seller. The buyer agrees to pay that price to buy. The seller agrees to sell at that price. There's an agreement, a fair price. And I say fair in air quotes. So there's always at least two fair prices. There's the trading price, the close of the bar, the high of the bar, but there's also the agreed upon average, the objective average of the past 20 bars. So we're going sideways far above the 20 EMA. So if we're going sideways far above the average price, bulls are paying far above the average price. They want above average price action. They want momentum. They're not getting it. They're failing to break out of highs, so they're bailing out. But still not great for the bears, even though it's still above the average price. Now we're low in the range. This average, using the price action, the bars, maybe the high of the range is somewhere up here, the low is somewhere down here. We're testing the lows. The downside might be limited. Then you take into consideration the gap up. Maybe we test, give me 1 second. Maybe we test the midpoint from the close to the open of today. So probably support in this area. You can see the market had a hard time falling much below here. Lots of overlap on the way down. Notice the bears not getting consecutive bars. Every time there's a bear bar, there's a bull bar. If you bought the close of every bear bar today, you at least made a scalp. And that was the recurring pattern all day long, or at least in the opening range. So there's a trading range on the open, most bars completely above the moving average, really just one close below the EMA, but it's a late leg, 1, pullback, 2, 3, subdivided into 2 legs. Also the biggest bear bar, sign of exhaustion, testing a breakout point down here. So the bears really needed follow through on 9, and it failed in a big way. And if you thought bar 9 would get a second leg down, maybe you enter on a pullback at the breakout point, the bar 5 low. It's right near Friday's high. So both of these lines reasonable to sell if you're betting that 9 gets a second leg, but it fails in a big way. You sell here, bar 5 low, supposed to be resistance. We break far above it, closing on its high. Disappointed traders. Here, the resistance becomes support. We test it, bad low 1, might be a breakout pullback for the bulls. Traders buy. And I want to back up what I was saying about the average price. I said there's always at least 2 average prices. And when I say average, average is of course, if you take the moving average, the closing price of the bars, whatever the period happens to be. So I have the 20 bar EMA. You take the close of the past 20 bars and find the sum, add them up, divide it by 20, you get the average. But when I say average, I'm also meaning the fair price. I'm kind of using average and fair interchangeably, because if a trade takes place, then a bull and a bear thought the price was fair to sell and to buy. So there always has to be at least 2 different average or fair prices or midpoints. And I think about that and I think every price is a midpoint to somebody. You have so many different charts, algorithms, however other traders and other algorithms are trading. There's an infinite number of ways to do it, and we don't know what they're doing. But everybody takes a trade because they think it's either a fair price or it's a good deal, and they think they can make money. So how can everything be a midpoint or a fair price? Because everything is relative. How do you say that something has value? you compare it to something else. So a lot of average price action, a lot of trading range price action going sideways. We've had 3 or 4 legs down, and it looks like a leg in a trading range. Probably going to test the highs plus the gap up, likely to get a second leg at least one tick above bar 4. So there's a target. If you buy, maybe stop below bar 9. And then we get into midpoints. Let's say you buy the close of 12. 1 times your risk. You're breaking out above the high. Stop down here. It's not ideal. Your reward is equal to your risk if you go for the breakout, but if you go for a test of the top of the range, you have to buy a pullback. Even then it's 1-to-1, and it looks like it's 50-50. The direction is not clear. But at this point, might be always in long. We have a rally, but not strong. There's a pause in between, but since there were 3 or 4 legs down, and we had a gap up, and this looks like a leg in a trading range, we've tried to go down, we might have to go up. So yeah, we might go higher, but it might be better to buy pullbacks, buy in the buy zone of bars, buy below bars. We're going more sideways to up, but it's very subtle. There's a gap. There's a negative gap here, or a body gap. Close of bar 13 does not overlap the close of bar 10, or even if it's the close or the open of bar 11, there's a gap. The tails overlap, but it's very subtle. There's a small gap between those prices, easier to see on the line chart. And you can see that gap is staying open, the gap being the close of bar 10 and the closing price to the right over here. So we break above it, we're not closing the gap, and we start to rally. We keep testing it, but we're going higher. So there's an open gap there, and it's subtle but meaningful. Then there's another gap. The close of bar 18 and the closing price up here. And this one's a legitimate gap. There's a space. The tail of 21 did not overlap the close of 18. Spiking channel, probably going to pull back, but likely support here. Bad buy signal bar 19, trapping traders who sold above or did not buy, and the market rallied for a couple of legs. 1, pullback channel 2. So we're going to test probably the bottom of the channel, the 21 low, maybe the breakout point, and ultimately we do on 26. Big looking bear bar, but bad context. Rallying with a couple of open gaps. Trying to break below it, but no follow through. 28, a bar that now we've had this rally, a couple of legs down. 26, pullback, 27, and then 28, bull bar, closing on its high. Probably better to exit shorts above it. Okay to buy above 28. Because we may have to test the high of the day. The bear is really not doing enough to convince traders to sell. There's a bull trend line trying to break below it, but failing. The moving average has been support all day. Bull breakout and follow through. Follow through bar bigger than the breakout bar. That's good for the bulls. The problem is the context. Now we're at the top of the range. But it's a strong enough breakout. Probably buyers below. You could even buy the close and be willing to scale in on a reversal, but you do run the risk that you're buying high in the trading range. But if you're buying here, stop below 27, you buy the close of 29, 1 times your risk is up there. We're not even sure if we're breaking out of the trading range yet. And then 30, disappointment. But look where 30 tested, that breakout point. We were buyers at that breakout point, and then we rallied. So minimum follow through for the bulls 30, but really not breaking out of the range yet. So disappointing. Might be buyers below. Going sideways, nothing to sell. The bear's not getting a reliable sell setup. Might have to go higher to find sellers. What about selling 33, micro double top? But is 33 enough to reverse 28, 29? Probably not. Open gap Negative gap using the bodies, the closes of bars. 33, there actually might be more buyers below. Maybe at a distance, there might be a scalp to sell here, but better to look to buy, okay to hold long. We've been rallying since bar 10, although very slowly. But think about the trader's equation and measured move targets. If you buy up here, stop below 27 or 28, target 1 times the range of the breakout. Maybe you just use the breakout bars. Is it more likely we're going up here or down here? We're probably going to go higher. This reversal attempt, to me, looks weak. And again, the moving average has been support really all day. We tried to break below it here, but failed in a big way. And since then, could not close below it. Plus on the gap up, it could be a big spike, pullback, and channel bull trend day. So 34 going lower, but now testing below these lows. If it's a spike and channel on a smaller time frame, this is the low of a trading range. Again, testing a breakout point where traders are trapped and where what was supposed to be resistance became support. If you bought the close of 25, disappointed, 26. You can see traders tried to get out at break even during 27. They did not quite get there. And the close of 25 should be resistance. So might be reasonable to sell up here, but if you do sell, you got trapped on 29, and that makes the close of 25 this area support. So we try to break below it, could not quite get there before reversing up. And if I had to choose between buying above 35 or selling above 35, I'd rather buy. To me, the context today is a little more bullish. The gap up, the bars being above the moving average. There's no gaps on the way down. The sell-off is weaker than the rally. It's hard to see, but there's, again, little gaps in here. This gap was open. We tested it, but then created another gap. Reversal attempt is weak. Now we're breaking to a new high, 36. The bulls want follow through. But strong enough breakout, 35, 36, second leg up likely. Even if we pull back first and then going higher, 37 might be by the close. But one problem with buying here, you might be getting close to resistance, measured move targets, maybe leg 1, pull back, leg 2. We start to slow down. So we might start to see profit taking here, but we're still probably going higher. And if we have an always in mindset, we just think about this chart from the perspective of an always in bull. Where do you have to get out if you bought any reason through here? Maybe you get out below 26, strong enough bar for a second leg down, but then 27 became the second leg. 1, pull back. 2, you can buy again above bar 28. I don't think 13, not strong enough to sell, even though it's 2 legs up, it's really tight, and it's after 3 legs down and a gap up. 15, bad signal bar, it's a bull bar, consecutive bull bars. Another bad sell signal, okay to hold long. The next stop order sell would have been below bar 23. Do you really want to sell 23? What's the argument? Well, top of a bull channel, double top. There's reasons to sell, but even just look at bars 20 through 23. Spike, pullback, channel, probably support the 21 low. I mentioned the 19 high. This area became support, so the downside might be limited, and there's gaps open. So probably better to be looking to buy or long. But can be risky. You might be at the top of a trading range. I like the fact that the bars are above the moving average today. It's different if the moving average is flat down the middle of this, but you can see it is slightly more bullish. I mentioned you might get out below here, but you can just buy again here, and then where do you get out? 33, not really strong enough. You can expect a minor reversal, but nothing to panic out about. And then where's the next reason? So you can see how if you have an always in mindset, the market can go a long way. If you have a target, you might have been, maybe you took profits at the measured move target, but if you held long, waiting for a bear bar that needs a second leg to get out, you could hold a little bit longer. Minor reversal, couple legs down to the moving average. Enough of a pullback that there's probably resistance at the new high. Probably going to get a new high, but now we're in the channel phase, sellers above. And then 58, you could exit below, but it's really the first close below the moving average in a lot of bars, and it's a nested second leg. What I mean by that, if we had two legs down here, one, pullback, two, but it also could be leg one down to 51, pullback, second leg trap at 58. Sort of a stronger looking sell-off here than over here, but that's common with second leg traps. And if we think about the always in direction, is this a major reversal or is it minor? Probably not enough bars to be major. And here's the bull trend line. We're hardly breaking it. Where are the big consecutive bear bars? Where are the bars completely below the moving average? It's probably minor. So 58 might be actually a great place to look to buy. Where the bears need one more bar, they're probably not going to get it. So a weak follow-through bar, 59. 3-bar micro channel, might be sellers above for a second leg down, but still overall probably more minor. At this point might be a wedge. Maybe 59 is leg 3. 1, 2, 3. But to summarize, probably not a great place to look to sell here. Bears getting a second leg down. Now we're testing prices to the left. 35 through 37, breakout, and then a pause on 38. And that might be the start of the channel. Spike, pause, channel. And the bottom of the channel, the start of the channel, often becomes the bottom of a trading range. 3 pushes down, 1, 2, 3. Might be a double bottom. After this breakout, there's an open gap, trapped traders, probably support in this area, and it's being shown or manifesting in 2 different ways. The open gap, the bottom of the channel being support, and 3 pushes down. Bears becoming exhausted. They're trading against this more major trend. This is more minor. Test the bottom. Bar 38, begin to reverse up. So 65, that's a bar that if you're short for any reason, it's probably better to just exit above 65. You have several legs down, and you're trading against the major trend. Now you're testing a support area, and then it's a pretty good buy signal bar. Yes, we have gone sideways for about 20 bars here. And there are bars completely below the moving average, but as far as the strength of this trendline break, it's more sideways than down. The bears don't have consecutive big bars. Even the trend bars are not huge. So trading range more likely than reversal into a major bear trend. So probably going to test the highs. It looks like a trading range at this point, but the upside might be limited for the bulls. Disappointed traders up here, but the downside probably limited. Might have found the bottom down here. Ultimately, we stayed in this range for the majority of the remainder of the day, trying to break out here, but one breakout bar, no follow through, bear bar closing on its low. Looks like we're failing to break out of the trading range. It might still be a bull trend, just a more broad channel like this, something like this. The question is, did the bears get below a major higher low? If you use stop orders and like a stop order below 33 here, swing point, and then a rally to a new high. The major high or low might have been bar 35. You can see we didn't get down there, so this is still more major high or low. These lows down here, 42, we broke below it. Is 43 a major high or low? I don't think so, because the breakout to a new high wasn't very strong. A couple of dojis, bull bar, but huge tail, closing below its midpoint, then an inside bar. Compare the strength of that breakout to a new high. After that, stop order below 42. Compare that to over here. Bull breakout, reversal attempt, there's a stop order below 33, and then trend resumption, and that's a much stronger breakout above this swing point. And to me, that makes 35 the major high or low. 33 is the swing point. Breakout, reversal attempt, it's a pullback, continuation to a new high with consecutive strong bars, pretty strong micro channel. So 35 becomes the major high or low. Compare that to over here, break below 42, then break out to a new high, but again, dojis, weak bull bar, not as strong as over here. So this might be a more minor high or low. So breaking below here doesn't necessarily mean trading range or bear trend. It might be a trading range, but to really convince traders, we need a deeper pullback, maybe all the way down here. And even then, it would probably be a trading range instead of a bear trend. Trading ranges happen more often than opposite trends, major trend reversals. But that's about it for today. I think I covered everything I wanted to talk about. Actually, there's just one more thing. One thing I was thinking about. Those of you who listen to Brad, usually when he does the end of day reviews, I think I've heard him talk about it there. He tells this story, and it's once removed because it's a story I heard from Brad and now I'm telling it, so I don't know the details, but what I know is he told us a story about when he was in college. He was in maybe like a finance club and somebody, or just a financial class, and a CEO of an institution, like a investment firm or a bank or something like that, the CEO came in and talked to his group, and he said, technical analysis is impossible, or it's a joke, and day trading is impossible. He said something like that. And Brad said he doesn't know why he said that. And he doesn't elaborate much on that, but I thought more about it. Just the kind of thing, it's a story that I think about from time to time, and I feel like I'm never going to forget. Because it confuses me why somebody in his position would say that. And it boils down to one of two things to me. Those are, one, he's either just ignorant and he really doesn't know that day trading and technical analysis is possible. Or two, he does know, but he's trying to misguide college students for some reason. If he knows the truth that it's possible, but he's saying it's impossible, then he's basically just lying about it. Or, again, option one is he's just ignorant. He really doesn't know, and he thinks he knows, but he doesn't. And I don't know which one is worse. For someone, and I don't know the institution, I don't know any of that, but when I hear institution, I think a firm that manages billions of dollars. For someone in his position of authority to say something like that, it really confuses me. And yeah, so again, I don't know exactly what to make of that, at least not yet, but I just don't know which one is worse for that guy saying that. But yeah, just something fun to think about, I guess. But that's it for today. So I appreciate everybody for watching, and I'll talk to everybody soon. Thank you.